How are we doing, guys? Welcome back to the course. In this section now, we're going to begin incorporating different aspects of trading into our actual technical strategy and our technical approach. So we spoke about fundamentals earlier in the course, and really fundamentals and technicals are separate aspects of trading, right? You're going to want to do your fundamental analysis for the overall directional bias on a trading pair. And you'll also then want to do your technicals on a separate note for finding intraday opportunities and shorter time frame opportunities, okay? So really, fundamentals are not as important as technicals, because if we can understand the technicals and we can understand the way the market moves based on supply and demand, based on order flow, all these other things we've spoken about so far, then we can trade successfully, okay? But it is nice to understand fundamentals as an additional basis layer of confidence and clarity for finding successful, profitable trades. So I'm going to show a few examples of how we can actually help to gauge long-term direction by using fundamental analysis. Our key factors of fundamental analysis are going to be following geopolitical events and also central bank data releases. Now, first of all, we're going to talk about geopoliticals, which are generally, on the long-term time frame of things, the ones that are going to have the most lasting long-term effect in the market. We'll also have a quick look at central bank data and how consistent central bank data, growth of an economy or weakening of an economy, is going to help us to gauge direction there as well. So we're looking now at the USD ZAR chart. This is the US dollar versus the South African rand. And I'm showing you this because South Africa is a country that has fallen into recessions consistently. The economy is unstable, to say the least. Okay, and while we do have periods where the economy is performing well, it is normally overwritten by a quick recession. You know, 2 recessions within a 2-year period and things like this put this thing in quite a lot of danger of decline, right? So looking at the US dollar versus the South African rand, we can see all the way from back in 2008, pretty much consistent uptrend. Well, yeah, a clear consistent uptrend. We have had a few phases of markdown where we've been pulling back to lower prices. But overall, the dollar has gained so much ground against the South African rand. So indicating then recessions. First major recession marked on the chart began in 2008 and ended in 2009. Now, if you view the chart here, we're in 2008. Look, you can see it on the bottom axis, 1st of July 2008, right? This area where South Africa fell into a recession, it stumbled so hard against the US dollar that the US dollar shifted up quite a lot. All right, if we actually look at the gains made from the dollar into those highs, you know, that's a 36.8% value increase for the dollar versus the South African rand. So this area here really indicates the recession and shows you the effect that recessions and geopoliticals like that have upon a currency and a currency cross. When South Africa begins to struggle economically, the dollar increases dramatically against it, okay, for a number of reasons. Because for one reason, the dollar could have been having a good year and performing nicely. But on another note, because this is performing so badly and this is a recession underway, investor demand for the South African rand completely dries out. Okay, people are not looking to hold a currency through a recession. They don't want to hold their wealth in a currency that is devaluing significantly, so they will go and shift money elsewhere. Now, another good reason is because the US dollar is a safe haven currency. So when shit hits the fan, so to speak, money is often shifted into safe havens. Safe havens are like gold, silver, the US dollar, and the Japanese yen. Safe havens are going to be spoken about very, very soon, about 2 videos from now, because we're going to be talking about safe havens and how they affect the currency crosses and currency values. But for the meantime, then, we can just see that how the recession has really driven price down against the US dollar here. Okay, we see a big increase in the US dollar against the South African rand. And then when that recession begins to die out early 2009, we actually see a rebound then, where the South African rand builds a lot of its strength back and pushes the US dollars out the down. Now, that's a really nice indication of how geopolitical sway the market, because this is on a monthly chart. But if you know that South Africa is slipping into a recession, if we just drop it down to a low time frame, we may not have past price data all the way that far back, actually. We'll try the daily. Bear with me, bear with me. So if we were to view, here we are. If we are to view this, we can see then on the daily chart, when we see South Africa entering that recession, this could then be a indication to begin looking for longs against the South African rand. Okay, if this is something that you trade on your watch list, or even as a position trade investment kind of thing, where we're buying this for the long term against the currency, knowing that this economy is trading in a recession and this economy is having weak performance, that gives us then reason to begin looking to buy against that currency or to sell that currency off. Now, if you were to buy this safe haven US dollar versus the South African rand through that recession, the profit would have been immense, okay? Especially on a margin trading account, a Forex trading account, you could have made some serious gains from buying this thing up. I mean, this is the daily chart, and you can see the significance of the movements and the strength of that bullish momentum. Almost looks like a Bitcoin chart. So that's just really indicating then how geopoliticals sway the market and how you can actually trade on the side of geopoliticals by understanding recessions, wars, pandemics, things like this, and the currencies and the countries that they're affecting the worst. You can then trade against those currencies and make a lot of money that way. So that is how we're really going to use geopoliticals. And as I mentioned, the South African rand is a currency that often sees weakness, right? The South Africa economy is not entirely stable. A lot of recessions have happened over the past 10, 20-year period, and they continue to happen to this day, right? 2020 still. So basically what we have here is a safe haven currency, one of the, if not the biggest currency in the world, that US dollar, trading against a very weak currency that is open to a lot of downside, a lot of stress and a lot of pressure, recessions and weak economic performance. So knowing this then, the US dollar becomes an attractive buying cross versus that South African rand. And as such, if you'd have traded that in line with those thoughts and with that logic and with the understanding that this is a weak currency versus quite a strong safe haven currency, the buying opportunities brought to you through this USD ZAR pair would have been immense. Okay. So that is how we're going to be using geopoliticals to our advantage. We want to understand the state of one economy versus the state of another. And then we want to trade that in line with the technicals. So the buying opportunity for USD ZAR really never stopped. We have had a few sharp pullbacks, but at the end of the day, we are consistently making new higher highs still to this day, right? April 2020, all-time high. So that is an example of a recession in play and a weak currency versus a strong one, okay? I'm going to show you now the British Strength Currency Index. So just before this, we spoke about currency indexes and how we can actually use these to help gauge trend direction. I'm going to start us off on the monthly chart, and basically you can see here all the while from 2008 we have been downtrending. So the pound is not something that has been performing too well. In the long term, that is. There have been a lot of pressures on the pound. But what I really want to highlight to you is this here, okay? What is this here? This is June 2016. Now, what happened in June 2016? Brexit, okay? As we can see, kind of sideways, bullish and bearish movements. We are trending down overall, okay? We cannot ignore that, but we are slowly moving, right? The momentum, the volatility, slow, sideways, not too bad. And then when that referendum hits, and when it's announced that Britain will be leaving the EU, off we go. We have a huge tumble, right? Speculation, huge there. So many traders looking around that Brexit vote to buy it one way or to sell it the other. And now we saw a huge attempt to run up. So this shows the volatility in the market, right? So many buyers, so many sellers. But essentially, speculation pushed the market down in the end because Brexit is seen as something that's going to cause a lot of economic hardship for the UK in the near future. So there we go. We can see since that Brexit referendum, we have literally never traded that high again. The market tumbled. We've even gone for a retest. We've even attempted to trade that high, but the market will just not allow it. And now here we are making new consistent lower lows and lower highs. So the British currency index, the British Pound Currency Index is showing the value of the British Pound as a whole versus all the other currencies weighted in favor of the British Pound. And as we can see, consistent new lows are being found. And this is clearly indicated, right? You can clearly see the dramatic effect of Brexit with much more volatility and momentum than your usual bullish or bearish candles. So that right there is a really solid indication of how these fundamentals and how these geopoliticals are affecting the market, okay? We've never traded that high again. And this actually becomes an area of interest then. If we go trade up into that, we know that somewhere up here, a rebound is likely to occur. We all know that Brexit is weakening investor demand because the future of the UK is highly uncertain. There's a lot of stress and a lot of pressure on the UK now to sort a deal and also to come through with that deal and run the UK, strong on its own. Allow the UK to run well independently without collapsing. So really, investor demand is not there. There are not a whole lot of investors who are going to want to keep their wealth in the Great British Pound, in a currency with a lot of hardship ahead. So we can gauge from that then, this negative referendum vote and the lack of investor demand that is now in the British pound market, we can gauge from that overall we are probably going to continue running in a downtrend for quite some time. So knowing that we have these hardships would have allowed us to trade this down, and so many opportunities have arisen to trade this market down. Okay, of course we do have pullbacks, as every market does, but for the past 4 years we have been trading in a downtrend, new lows, new lower highs. So yeah, cool. That's another example of geopoliticals there. This time the Brexit referendum and how it has negatively affected the pound. So another thing then we need to be focusing on, as mentioned, is economic performance. So from here, I'm going to scale in, right, focusing on this current price action. From 2018 to 2019, the US economy was all good. Interest rates were being consistently risen, and everything was looking good for the US economy, right? Stock markets were continuing to reach all-time highs, and the actual interest rates and the decisions from central banks were looking positive, a positive note. There was no need to encourage spending to prop the economy up. So rates were continually being risen, which obviously is generally a good sign for the economy. Monetary policies too were very positive and popular, and allowed the market to keep running in this uptrending motion. Now, what actually happened then? 2019 to 2020, a lot more hardship has entered the markets. The coronavirus pandemic has also affected the markets. And what this has caused is a stagnation. That bullish momentum soon dried out. We've consistently continued this uptrend. And in recent times, things got really, really choppy. Now, here we have this slow grinding sideways, but still upward movements. This is really the effect of those slowing interest rates coming into action, right? Interest rates begin to get slashed. Monetary policy starts to take a downturn and a bit more of a negative outlook. This is reflected in the chart in this US dollar currency index. And as we can see, that bull momentum, that positivity, that euphoria fizzling out and turning bearish, turning negative. Now, this is when we really see the mega effects of the coronavirus pandemic. So this is using that central bank data mixed with geopoliticals. We can see it all here in the chart. We have that positive moment where the US economy is looking great. We have everything is on the rise. Interest rates are continually being increased. Monetary policy is looking positive. And then things begin to weaken. The market begins to go sideways. Interest rates are getting cut to suit the newer and more negative economic outlook. We can see this in this sideways motion. So you can see that everything is really reflected in the charts. So you know then that when we're seeing these central bank data releases, these positive monetary policy statements and these positive interest rate decisions, you can see how, as I've mentioned before, it's normally positive for a currency. You can see that happening in the chart, okay? You can see the positive effects actually playing out right there in the chart. And then when things begin to go a bit more sour, when we see these interest rates getting cut, when we see monetary policies beginning to look a bit more negative, we actually see that as well reflected in this sideways choppy price action. So of course, using this to our advantage, we can gauge which way overall the dollar index is currently going. Now, for quite some time, we've been expecting a rollover, and this coronavirus pandemic has really caused that. The US, being one of the most, if not the most hard hit countries in the world, has taken some serious shock. So we've had a lot of sideways choppy action, huge volatility increases in the market, making the market go wild. Okay. Fiscal stimulus packages where money is being injected into the economy to support stock markets, to support markets, and to support the dollar had their temporary relief. But now everything is really catching up, and down comes the dollar versus so many different currency pairs. Okay. So real life events are here, documented right here in these higher time frames. We can actually see them and read them inside of the charts, and that's exactly how we're going to incorporate them into our technical analysis. We can actually view these moments where the economy is performing well, and we can trade in line with that, right? If we know that monetary policy and interest rates are positive, then we know to buy with the currency, buy with the trend. When we begin to see everything stagnate, we can actually begin thinking, okay, maybe it's time to begin reconsidering. Maybe it's time to actually think about the possibility of reversal. And as you can see, we will have, this has been replicated in the charts, reflected in the charts, where we see this buying demand easing out. We see investor demand easing out of the market. And then when this pandemic hits, the market goes wild, and now everything is caught up and we are dipping to the downside. So really, real world events are documented right here in the charts, okay? That's central bank information and those consistency, keeping up with monetary policy statements and interest rates is reflected right here. So that's really how we're going to use fundamentals inside of technicals, okay? We want to view those things happening on real world, real life scenarios, really on the charts right there in front of you. When things are looking good, the charts are going to be looking good. When things are looking bad, the charts will be looking bad as well. When things get completely crazy and out of hand, like a pandemic, a war, or US-China trade tensions, things like this, that's when we're really going to see this insane movement like this. In the end, though, fundamentals will shine through in the charts regardless. So overall then, just to conclude this little video, fundamentals are going to be used to gauge overall trend direction on the longer term. Fundamentals are going to be used to get an idea of where the currencies are likely to move. When we understand, in this example, that the US is a major victim of the coronavirus pandemic, that is when we will understand that the chart is probably going to make some downside. And if you get in and you trade in line with the fundamentals, then when the chart catches up, you will be on the right side of it. Okay? We see so much negativity around the coronavirus in the US right now, that if you'd have got on somewhere in here, somewhere based on the technicals, in line with that fundamental knowledge that you have, you'd now be running in some insane profits. So geopoliticals and central bank information is really going to be used to gauge direction, okay? We don't use it to trigger entries, and we don't use it on a short-term time frame, because short-term time frame generally don't reflect fundamentals so well. But on the higher time frame and the longer-term view of things, these different fundamentals are going to work magic in helping us trade in line with the trend. So as we've mentioned so many times before, they are here to add clarity and confidence to your trading setups and to your outlook on the market. And I've shown you a few examples here: trading against currencies in recessions, trading in line with central bank interest rates and monetary policy statements, and understanding the real world effects of pandemics and wars, and trading in line with that knowledge technically. It's all going to work profitable, and it's all going to give you extra clarity and confidence that you wouldn't have if you were otherwise just to look at the technicals on the chart. So thank you for watching. Hopefully you found some value. Hopefully now you can understand and actually view the markets, the fundamentals occurring in the markets based on what I've spoken about in this video. In the next video, I'll be talking about economic data and how we actually bring that in, how we can view that in charts, and what we'll actually use that for. And from there, we're going to talk about safe haven flows in safe havens as I just have. This is probably going to be the most exciting bit and the most interesting bit of this little fundamental section. So it's a whole new addition to your arsenal, to what you know so far. We'll be talking about safe haven flows for commodities and also for currencies. So without further ado, let us dive into the next video and continue the learning on the topic of economic data.